Welcome back. And here we're going to discuss further about weak form market efficiency and move down to semi-strong form market efficiency. So here's the quiz. If the market is weak form efficient, you can make money using candlestick chart. Yes or no? The answer is no. Okay, which means the candlestick chart is our typical tool to analyze price pattern. We're going to talk more in detail about this candlestick chart when we talk about momentum, so wait for that. But whenever the price goes up in the US and Europe and Japan, you represent those upward movement with green light. 내가 green light로 보여줘. It's like, okay, let's go. Whenever the price goes down, you represent it with red color. Oh my God, bloody red, you're losing money. Okay. Of course, depending on the culture, it could be the other way around. Chinese culture, okay, China and Korea, South Korea somehow, not North. We represent upward movement with red. Downward movement with blue. Blue. Something blue means like something bad. Whereas red, they perceive it as good luck, giving you some good luck. Okay, so that's why. Anyway, so candlestick chart, okay, is an analysis tool for technical analysts, right? So looking price patterns and but that kind of price pattern recognition, does that give you money making opportunity? EMH guys say no. Okay, but behavioral finance guys say yes. The same thing but different conclusion. Why is the case? Wait for that. Okay, anyway, semi-strong form efficiency. Well, public information is already priced. That's the claim here. How does that work? Well, it goes against the notion of value investing, like Warren Buffett or stock analyst, right? What they do is to try to estimate the true value of your company, believing that the current price is not correct, believing that market is not semi-strong form efficient. Okay, so if you ask any stock analyst in the market, they will always criticize your professor. Oh, those economist professors there, book smart, they don't know anything. You need to be street smart like me. Okay, especially book smart say the market is efficient, but street smart like me, we find that that's bullshit. The price is not efficient. The information is still not priced yet. Okay, you can, with your intelligence, analyze those companies fundamentally, and you will be able to identify and then estimate the true value, and realize that the true value is vastly different from the current price that you observe. Okay, so ignore the professor and then move on. Yeah, that's for neoclassical finance guys. Okay, not behavioral finance guys. Anyway, so here's our ideas about the value investors like Warren Buffett. So here's a timeline. Okay, and then here is the either price or true value, and then the price. Let's say it is observable, just like in the red line over here, and you are standing over here. Okay, T0. And this is current price. The thing is, you study this stock like crazy and then found out that the true value turned out to be 2 times the current price, 100% up potential like this, let's say. Then what do? You buy it right now, buy low, and maybe 1 year down the road, maybe 3 years down the road, the price will converge to the true value that you estimated. By that time, you will sell high and then say bye-bye. Okay? So that's the idea of value investing. Okay? Good value. Yeah, it's undervalued. Let's buy it. So that's Warren Buffett kind of guy's ideas. But what does the economist say? Okay, neoclassical economists say you are not alone, maybe. So not only you, but also everybody else is looking at the same information. Remember, this is public information. So if your value investing idea was correct, not only you, but also the rest of the world, rest of the investors in the market must have calculated so. So much so that you're not alone in pushing the buy button, but also everybody else is pushing the buy button simultaneously. So much so that the price should have gone up to the target price right now, instead of having to wait 1 year or 2 years down the road. Okay, and then it will start to do random walk like this. Okay, on average they will stay in this true value later on. Okay, but the key point is that if your value investing idea was correct, you are not alone finding that, but everybody else will do the same, so that the price should have gone up to the true target value right now. But you know what? The price is still down there, not there. Okay, why is it here, man? Which means, well, given that the investors are rational, your value investing idea must have been bullshit. So that's the claim of this semi-strong form efficient market hypothesis. Okay, so Warren Buffett versus Eugene Fama, they don't go together. Okay, oh, that's hard to grasp, because Warren Buffett, we know he's a guru in economics, and then he knows about business better than anybody else, right? But how could he be disagreeing with Eugene Fama, the Nobel Prize winner? The investment philosophy is different. Okay, Eugene Fama, okay, he believes in semi-strong for market efficiency like this, no chance for value investors. So Eugene Fama's claim is that do passive investing, man. Okay, don't try to actively choose a stock picking, no way. Okay, because the market is semi-strong form efficient. On the other hand, Warren Buffett says what? Well, be an active investor, because the market is not semi-strong form efficient. In the long run, it will be efficient, but in the short run, there are some deviations like this, so that you can make money. Okay, that's the thing. Is there any evidence supporting this semi-strong form market efficiency? Plenty of them, actually. Okay, so here's one example. When Microsoft announced that they will take over Yahoo. What is Yahoo? That before Google, there was Yahoo, the search engine. Okay, seems like it's a Stone Age or something, about the time you guys were born. Anyway, but when, as soon as Google was taking off, the Yahoo was going down, and then the price was miserable. But eventually, Microsoft found out, oh, this is a good value stock to take over, so much so that they could expand into search engine business. Okay, what's the consequence? Bing, kind of things. Okay, of course, in the middle, the deal was blocked, but when the deal was initially announced, right, the price of Yahoo jumped up, skyrocketed instantaneously. Okay, this is daily stock price chart of Yahoo, and then it seems like the price was going up throughout the day, starting from here in the morning until the end of the day, like this. So if you bought this stock in the morning, maybe you must have earned a lot of money in the evening time. No way. The world is not that easy. So here I captured the screenshot of those 3 days. Yahoo takeover, okay? Microsoft, when they announced it in the morning of February 1st, right? The price skyrocketed instantaneously, okay? So much so that by the time I opened up this stock price chart, or not this one, but when I was starting to study that day, I already missed that chance, okay? It's public information. Everybody was punching the buy button immediately. So much so that the public information got priced instantaneously. 빛의 속도로 already reflected in the price. So no chance for me. No soup. No soup. 국물도 없어요. No soup. What do you mean? In Korean expression, no chance at all. No soup. Okay? Gone with the wind, right? So that's the reality of the market. Market is semi-strong form, efficient. We find supporting evidence for that, okay? And as I said before, neoclassical finance guys, they claim information is the only driver of price. Nothing else matters, okay? And then especially those information, what kind of information is it? Cash flow or risk of the companies. All kinds of, fancy news, whatever stories about the news. You may say bullshit or whatever, especially if it is marketing news or kind of advertisement or related things, spinning off, right? Spinning or saying something good about the company or bad about the company. Everything boils down to two things. Is it about the cash flow or is it about the risk of the company? Nothing else matters, right? So the finance guys, we live in a very simple world. Only the information, especially about the cash flow or risk, matters. Nothing else. And also the information, other classification of information, past information, current information, public, current information, private, okay? Until current information, public, we talked about it. Now, that's semi-strong form market efficiency. Now, here is another example for your exercise. Meta platform, Facebook, okay? At one point, I caught the screenshot. What happened on February 24th of 2024, this year, right? The price jumped up from about $400 per share to about $480 per share, which is like 20% up. Holy cow. We are not talking about, small stock. It's Meta, okay? The Facebook, one of the biggest corporations in the whole world. And 20% up. Man, what happened? Well, there was earnings surprise, positive earnings surprise over the past year. So what do you mean by earnings surprise? Well, their net income was better than expected. Easily put, they made money more than we expected. Okay, they made money more than we expected. Good news, yes. So the cash flow expectation went up, and that expectation got immediately priced like this. It's a nice case study about semi-strong form market efficiency, okay, being supported. So that's it. And in other, what is that? What is left is the secret of the company's private information. Does it get priced? If it gets priced, we say the market is strong form efficient. Okay, even your company's secret gets priced. Well, do we find supporting evidence? And the answer is no. Okay. Many research papers found that insider trading still makes money, which means insiders' information is not priced yet. Okay, insider trading, don't do it. If you get caught by the finance police, you will be jailed. Okay, But some of the insiders, right, they buy and sell with their personal announcements, right? We have, as the researchers have the data about when they were buying and selling their own company stock as a CFO or as a CEO. These guys have the top quality insider information. So there should be some adverse selection going on. Oh, the insider sold that stock. Oh, why? Okay. Maybe some bad reason is there. Okay. And then subsequently price plunges down, which means the insider information is not priced immediately, but it gets priced over time, so that the strong form of market efficiency is defied. Okay, insiders still can make money. That's why. Okay, can we make money by some trading strategies? Neoclassical economists, EMH guys say no. There's no free lunch in the market. Investment strategy? Good luck. Okay. So what's the conclusion? Be a passive investors, right? You know, index funds, right? Index fund is a portfolio or the mutual fund that puts their money onto all the stocks in any index. For example, S&P 500. Okay, we have SPDR index fund or index ETF, right? Exchange traded fund. We'll get to that idea later on, but index fund, basically S&P 500 index fund has all 500 stocks in their portfolio based on the market cap, okay, weighted average of all these things, so that this fund just follows S&P 500 index day by day. So no, you don't actively choose, oh, Apple, I'm going to buy it, but not Nvidia. No, that's active investment. Here, S&P 500, you know, you're passively just buying all these things together with the rest of the investors, right? So that's a passive investment strategy. Neoclassical finance guys say, just do this kind of passive investment. You will say, oh, that's no fun, and that's quite average. You will just perform just like average. That's quite average. Okay, but that's okay. If you have done investing right yourself, be an active trader, and you will soon realize just being on average in that market, stock market, is extremely difficult. Okay, the market is very, full of geniuses anyway. So it's very difficult just to follow this average. Given that, why not be a passive investor, right? Plus, if you try to put your money in some active mutual funds or hedge funds that actively selects the stocks for you, they will charge huge amount of fees. You want to save that fees, right? And transaction costs, buy and sell and all these things. Too much. So why not be a passive investors, right? That's the idea over here. You save a lot of money and just be an average. That's good enough. Right. Are prices completely rational? Is the financial market completely efficient? And neoclassical finance guys say yes. Where are those guys? Neoclassical finance guys. Minnesota, Chicago, Minnesota, and Carnegie Mellon. 3 schools over here around the Great Lakes in the United States. So either you call it neoclassical finance guys, or you call it Chicago, Minnesota, Carnegie Mellon School of Thoughts. It's up to you. This is where I am from, Minnesota. Okay, I learned my PhD in this way and got my degree there with my advisor there. But as I went to Singapore, I switched into behavioral finance because neoclassical finance, so many things have been done already. Okay, but behavioral finance, who are doing those? Well, the rest of the world over here. So, for example, Harvard, okay, and Yale, okay, Texas Austin, all these great schools are behavioral finance guys. They fight like crazy, right? But behavioral camp versus EMH camp, right? Now, behavioral finance guys, right, to this argument, they say no. In some cases, prices can deviate from fundamental values and become mispriced. And prices can do this because investors make mistakes, which are not always corrected by other traders. And it's not corrected, okay? It does not get corrected, okay, immediately. And there's some pattern. You can predictably see it. And it just does not go away. Okay, so that's that. Yeah, in the next video, we're going to talk about why is EMH so important, and then we will talk about the scenarios that support EMH. So wait for that. Thank you for watching.